Yesterday, the Federal Reserve held interest rates exactly as expected, and the market had its worst Federal Reserve day under a new chair since 1994. The S&P fell more than 1%, the Nasdaq fell more, and bond yields surged. Why would a hold do that? Because the message was hawkish. Kevin Warsh's first dot plot deleted the rate cut the market was counting on and put a hike on the table. 9 of 18 officials now see rates higher by year-end. The easing bias is gone, and traders walked out pricing a possible hike as soon as October. So where's the edge? Not in what has to borrow to build into a hawkish Federal Reserve, in what funds itself. The hawk just priced the build. The evidence, not the noise. This is the asymmetric. This is the asymmetric, issue 20, the hawk, tech and crypto investing for thoughtful retail from an operator's lens. Last issue, the bill came due. The artificial intelligence build had gone debt-funded just as a new Federal Reserve chair sat down to set the price of that debt. He set it hawkish. Here is the one-line read. The Federal Reserve held at 3.5 to 3.75%, unanimous, fully expected. But Warsh's first dot plot deleted the 2026 cut and put a hike on the table. 9 of 18 officials now see rates above today's range by year-end, with the committee lifting its 2026 inflation forecast hard to about 3.6%. The market took its worst new chair Federal Reserve day since 1994 as yields surged. The debt-funded build now reprices at a higher rate. Own the layer that funds itself, underwrite, don't romance, the layer that must borrow. You'll see the same labels throughout. Confidence, high, medium, or low. Consensus versus variant, what the market believes and where we may differ. And on every call, what would change our mind. That's the discipline. Part 1, the macro regime, the hawk lands, the easing door bolts, and the build's rate goes up. The 30-second frame. 1. The verdict came in hawkish. The Federal Reserve held, but the dot plot deleted the cut, added a hike, and lifted the 2026 inflation forecast to about 3.6%. 2. The tape took it straight down, the S&P off more than 1%, the Nasdaq more, the Dow down about 500 points, the worst new chair Federal Reserve day since 1994. 3. Yields surged toward 4.5%. 4. The carry tightened, with the Bank of Japan's hike to about 1% taking effect into the same window. And 5. The war premium kept bleeding, with oil falling towards $75 on the signed Iran truce. Start with the Federal Reserve, the event. It held at 3.5 to 3.75%, a unanimous vote, about 97% priced. The substance was everything else. The new dot plot removed the prior 2026 rate cut, lifted the median dot to about 3.8% from 3.4%, and raised the 2026 inflation forecast hard to about 3.6% from 2.7%. The easing bias language was struck, and the statement was paired to a terse, data-dependent core. Warsh declined to submit his own dot and announced task forces to overhaul Federal Reserve operations. 9 of 18 officials now see rates above today's range by year-end, at least one hike, and traders dumped short-term treasuries and left the press conference pricing a possible hike as early as October. This was a genuine hawkish surprise, not just no cut. Now the tape. This was a broad de-risk, not a rotation. The S&P fell 1.2% to 7,420, the Nasdaq fell 1.3%, and the Dow lost about 507 points, with Microsoft, Meta, Alphabet, and Amazon all closing red. The 10-year Treasury yield surged toward 4.5%. Tuesday was a narrow rotation, a Dow record while the Nasdaq fell. Wednesday was the opposite, everything down together. Into rising yields. A broad de-risk into surging yields means the discount rate just rose for everyone. That rewards self-funding cash generation over borrow-to-build growth. Then oil, the carry, and the havens. Oil kept falling, crude towards $75, Brent below $78, as the United States and Iran signed and enacted an interim agreement, a 60-day test, reopening the Strait of Hormuz. That's disinflationary if it holds, the one thing that could eventually give Warsh room. The carry tightened too. The Bank of Japan's hiked to about 1%, its highest since 1995. Compressed the yen carry funding leg under global risk. and gold eased to about $4,325 an ounce as the higher for longer dots lifted rate hike fear, the near-term drag on a non-yielding asset. The durable bid stays structural. Part 2, in focus, the one fault line the Federal Reserve doesn't set. A hawkish Federal Reserve reprices everything that runs on the rate. The one large story that runs on regulation instead is the move to put real-world assets and equities onto regulated crypto rails, and our live, filings-grounded workup landed on Coinbase, the listed proxy on that unlock. In the year ended December 2025, Coinbase earned $1.26 billion on revenue of $7.18 billion. With $2.4 billion of operating cash flow and a fortress balance sheet, over $10 billion in cash against $6 billion of debt. But then the cycle turned. In the first quarter of 2026, revenue fell about 30% year-on-year to $1.4 billion, and the company swung to a net loss of about $394 million as crypto cooled. Now the debate, the bull in the numbers, the dominant United States regulated on-ramp, with a second engine that doesn't depend on trading volume, a share of the reserve income on the USDC stablecoin, which a higher for longer Federal Reserve actually helps. The full year was solidly profitable, the balance sheet is a fortress, and if the market structure bill becomes law this summer, the compliant venue is the structural winner. The bear. In the numbers, the most recent quarter was a loss, and the bull case is a bill. Revenue fell 30%, operating profits swung to roughly break-even, and this is a brutally cyclical, volume-dependent business levered to exactly the liquidity tape a hawkish Federal Reserve is now pressuring. The bill has passed the House, not the Senate. The read, a research view, not a call. Coinbase is the listed proxy on the one fault line the hawkish Federal Reserve does not set, the regulatory unlock of on-chain assets. It pairs a genuinely dominant, profitable through-the-cycle franchise with acute cyclicality and a catalyst that is a bill, not a number. Respect the rails and the float income, but underwrite the cyclicality and the legislative risk. The lower beta way to own the same plumbing thesis is the regulated settlement layer itself, Circle, the USDC issuer. The havens and crypto took the hawkish read straight. Gold eased to about $4,325 an ounce as the higher for longer dots lifted rate hike fear. We cite gold by level and driver, never a contested period return. Bitcoin slid towards $64,000 and Ether traded near $1,745, both lower the morning after the Federal Reserve, despite the signed Iran peace. That's the tell, crypto is trading the rate and the carry, not the geopolitics. Under the surface, Ether is up about 5% on the week, while Bitcoin is down about 1.5%, a rotation into Ether on the tokenization catalysts, and the real fragility is in the structured product layer, not spot. Strategy's preferred instrument hit an all-time low, reviving the risk of a forced Bitcoin seller. A liquidity proxy, not a haven. And the thematic. A hawkish Federal Reserve sharpens the self-funding lens. The build went debt-funded. The Federal Reserve just made that debt more expensive, deleting the cut, adding a hike, surging yields. The megacap-led broad sell-off into rising yields is the market repricing duration, not picking winners. So own what funds itself, the toll booth that prints cash, the sold-out memory, the float income rails a higher rate helps, the lower leverage fuel. The hard asset at its floor, and be wary of the borrow-to-build layer and the bet-on-the-bill layer, whose returns hinge on a rate and a calendar that both just got harder. Part 3, the hawk price the build, own what funds itself. What we are watching over the next 10 days, Federal Reserve speakers and minutes, do other officials validate the October hike pricing, the market structure bill in the Senate with an end-of-July window, the Iran truce a 60-day test, Oracle and whether its free cash flow inflects now that yields surged, Bitcoin and the yen carry, crypto volumes and Coinbase, Nvidia and the hyperscalers' capital spending, gold against its structural bid, megacap leadership, and the pace of tokenized assets moving on-chain. And we keep score in public. Coinbase enters as the lead regulated rails proxy, the listed bet on the on-chain unlock. The Federal Reserve verdict marked hawkish, Oracle on financing risk, Nvidia the self-funding profit center, Micron on sold-out memory, Circle on the settlement rails, Palantir on sovereign artificial intelligence, Talon and EQT on power and fuel, Freeport on copper, gold, constructive, Bitcoin, a liquidity tape. These are dated, falsifiable calls, and we grade them. So where does it land? Warsh came in hawkish, the cut is gone, and a hike is on the dots. The build's rate just went up, and the asymmetry is owning what funds itself. The toll booths, the sold-out memory, the float income rails, a higher rate helps, the lower leverage fuel, the hard asset at its floor, and the dry powder to deploy into the repricing. The crowd priced relief. The hawk priced the build. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.